Thank you, everyone, for joining me. My name is Frank Chaparro. I'm an investigative journalist at The Block, a cryptocurrency news and research shop. I'm based here in New York, and I'm joined by Caitlin Long, co-founder of the Wyoming Blockchain Coalition, David Mercer, CEO, LMAX Exchange Group, and then Greg Tusar in the middle of them is the co-founder and CEO of Tagomi. So we're going to be taking a look at the market from an institutional perspective, diving into different market structure related issues, as well as regulatory issues that are either helping or impeding some of the folks and firms that these three wonderful panelists often deal with. So I guess the first question, since we are just being gripped right now by a resurgence in the market, what from an institutional perspective makes this rally make sense? I mean, we saw it go up 3% when Fidelity, or rather when it was reported that Fidelity was going to be close to trading. Is it that? Is it something else? Greg, what's behind this move?
The honest answer is, I don't know. I do think that the infrastructure this time around, I think, is a lot more prepared than it was for the last rally, and I think with each of these, it gets more and more mature. Still a long way to go, but I think that, if you looked at last year this time versus now, you would see a pretty marked difference in the constitution of who's actively trading, what's happened to spreads, stability of market infrastructure, the presence of software and other people to aggregate exchanges and things like that. So the market's definitely matured, but in terms of what the specific driver is, whether it's news related to ETFs or those sorts of things, I honestly don't know.
Mm-hmm. But there's a lot of holes in terms of the market structure, right, David? I mean, you see this, and we talk about this all the time, whether it's the lack of a true qualified custodian in the sense of what we see with like a State Street or a BNY Mellon. What's the biggest issue hanging over the market as you see it?
For the institutional space?
Yes.
I think I'm probably going to disagree with Caitlin on this, but I actually think it's credit and quality of credit. I think we've learned a lot from the evangelists and the scientists out there in terms of blockchain technology, but the thing that's stopping institutional money, that real weight of institutional money coming in, is the quality of credit. We spend hours of every day and days of every week chasing the same Bitcoin or the same dollar around the globe. And unfortunately, as much as we want to have instantaneous settlement, it's not there yet. So Satoshi wanted a decentralized, trustless environment. He's got it. We have zero trust. And that's the big thing that's stopping the institutions coming in today.
Mm-hmm. What about the regulatory perspective? Thinking about, we've all seen the headlines out of Bitfinex and the New York Attorney General's office, and then a few weeks ago there was the Bittrex issues. And Caitlin, you were speaking at Fluidity last week about that. You seem to have, you weren't defending, but you were at least siding somewhat with some of these crypto platforms, right? And the myriad of regulations and issues that they have to go through and deal with. In terms of when you think about an institution, when they see things like that, is that maybe one of the reasons why they're a little timid to dive in?
Well, sure. If I think this industry is in the crosshairs of the regulators, and I think it's not fair. The regulators have not been even in their treatment. That's more the issue. I don't know the specifics of the Bittrex or Bitfinex situations. None of us really do, right? But what we do know factually is that the New York Department of Financial Services published an op-ed in CoinDesk blasting an applicant whose application they had rejected. Since when have we ever seen a regulator do that? And how does a company defend itself when the government attacks it like that? It has no recourse. And the same thing with the Bitfinex situation. I think what you were alluding to was, I was pointing out the double standard. Merrill Lynch essentially did the same thing. And the SEC made Merrill Lynch pay $415 million a couple of years ago for commingling its funds with clients' funds and commingling customer securities into an account that was pledged to Merrill's lender. And the SEC, those were essentially different details, but essentially what Bitfinex was accused of doing. And in other words, commingling their own coins with customer coins and commingling customer cash with their own cash, right? And this is something that Merrill was given time to sort out, and there was no gotcha-style run that was precipitated because of a regulatory action, whereas that's exactly what happened when the New York Attorney General went after Bitfinex. So I'm not saying those companies are without fault. They may very well be entirely guilty, but there is definitely a regulatory double standard.
You think there's a double standard, David?
Between, what do you mean?
Wall Street and cryptocurrency exchanges.
You think Wall Street's being punished more than the crypto guys, or the other way around?
The other way around. Being treated unfairly.
No, I don't think so. I actually think I take a different view, but that's normal for me. I think the best thing regulators have done is stay out, right? This is such a nascent market. We have to allow it time to breathe. There's going to be mistakes along the way. It's also very small, right? Just because I go and issue a new Hujima-flip derivative tomorrow doesn't mean a regulator should go regulate it. So I think the best thing they've done is let it breathe. To Caitlin's point there, yes, it is wrong that they come out and outwardly say what someone's been accused of before they've had a chance to defend themselves. For sure, I agree with that. But come on, there are some basic standards that we should expect. Hence why I'm in favor of regulation. Why LMAX Digital went out and got regulation from the only regulator in our jurisdiction, being the GFSC, as a regulated market operator and a regulated custodian, because I think you have to set the bar high. So self-regulated or not, I think we have to adhere to higher standards.
I got a question for you, Greg. When you operate a business in this market, one of the challenges people often cite is the lack of clarity in terms of the regulations. The reasons why we haven't seen some of these derivatives platforms go live yet is because we don't know if the CFTC is okay with an Ether future, a Bitcoin Cash future, et cetera.
Right.
You guys went through the bit license process. You have a good, view of the market given the clients you engage with. Is that an issue for them in terms of dealing with the regulations?
So probably the most challenging part now isn't, I think we have clarity that what we do is equivalent to money transmission, and we have to go and get our MTLs and be an MSB and so forth. It's really more on the security side of things where it's still sort of quite unclear. And I think that is a place where I think the SEC and FINRA have to step in and give some more guidance. And we are getting some of that in the form of tests and so forth that may give some clarity, but that's a place where I think the industry, in order to move forward, it feels like we need clarity on security status and these issues around customer protection, good control of assets, all of those sorts of things, and then maybe give it time to breathe after that before we figure out how fundraising and other things will work. But those feel like really threshold issues that are holding back quite a few people from deciding what can I trade and how do I hold customers' assets in a broker.
But regulators move slowly, right, Caitlin?
Well, not in Wyoming.
You're at the forefront. How do we?
And I'm dead serious. Thank you. I'm dead serious about that. Wait till you see what Wyoming comes out with. I think it's going to blow people away because the industry essentially self-regulated. We had the industry participate in drafting the Wyoming digital asset custody rules, which are designed to fit within the SEC qualified custodian regime. Now, of course, only the SEC can sprinkle that holy water, but yeah.
Sure, but when a large hedge fund sees that they have either, whether it's, I think South Dakota has its own designation, or maybe Wyoming now is coming out with one, is a large, investor, a 0.72-like firm going to look at that with the same, qualification as something that's federal or from a state like New York?
There's a huge difference. The securities are owned indirectly, right? The DTC is the legal owner of most securities. So there's really no difference in the custody regimes for securities because you never can own publicly traded securities directly yourselves. But you can own digital assets directly. So here's a huge difference. The custody approach that Wyoming's taking is respecting the way that these technologies work, which allow individuals to own assets directly. You can choose to own the assets directly. So for some, I think probably more for the registered investment advisor community, the high net worth and family office type customer base, they will care about that. For others, they're okay with owning the assets indirectly and pooling them in omnibus accounts and the like, and therefore taking a debtor-creditor relationship with their counterparty. All of us are in debtor-creditor relationships with our counterparties in securities today, period, because the only one who owns title is the DTC or Euroclear or Clearstream, et cetera, in Europe. But we will have the choice, and that's a powerful choice because it doesn't exist in securities today.
Custody is a big question in terms of getting something, a solution that, you know, will make investors comfortable. Another question is just these exchanges. I mean, we were talking about credit risk on the phone the other day, and exchange risk is a huge problem, and you have to figure out where you're going to route your clients' orders, and how do you engage with this market where an exchange is being hacked for 70,000 Bitcoin or 7,000 Bitcoin? You know, is that just part of the? Is that just something we have to accept, or is it ever going to get better?
So in our case, we try and manage keeping as little on exchange in terms of customer assets as possible and repatriating what we can back to other forms of storage, go through a rigorous diligence process, et cetera. So we connect to a list of places that we've sort of vetted. But I agree that from a credit perspective, we are missing some way to intermediate credit to have a central clearing agent, which is anathema to distributed finance, but really is necessary, I think, in order for the space to grow. To be able to face a central counterparty, to have credit intermediation is a big missing thing in the space right now.
But there are two things that butt heads, right, David? Like, how do you reconcile the two?
But I don't think you should blow up that
Should we
hack.
blow up DTCC?
I don't think you should blow the hack up out of all proportion, right? So let's face facts, right? So I run a broker and MTF back in the UK, Elmex Exchange Group. I budget for about 2.5% credit losses every year. If I don't have that credit loss, it means I'm not taking enough risk. But it's my loss, not the customer loss. So let's look at the custodian space. Elmex Digital has a hot wallet, a cold wallet, and a vault wallet. Frankly, yeah, okay, you can all try and hack into the cold and vault, and I can tell you I've got the best in breed multi-sig, whatever. But I have to believe that, and they're the only ones that have been insured by the Lloyd's market. The hot wallet is my risk, not my customer's risk. It could be hacked, and I think that's the hack we're talking about last week. I've no need to defend those companies, but as a percentage of their holding, it actually wasn't that great. So yes, you're gonna have to trust someone with your keys, with your digital assets. It might be you just trust yourself. And I'm very okay with that. But there's some other, we're talking about the institutional space, there's some other players out there, asset managers, the real money clients, who may not want to trust themselves, and they may want to trust their banks, and therefore you come back to the credit issue, right? Individuals might want to trust themselves, and that's okay.
Do you think institutions will ever be able to handle it on their own?
Well, I hope so, but right now they're certainly not prepared for that. The buy side in general is not prepared to self-custody assets, doesn't have the trade reporting structures built up against it. So that's why the digital asset custodian in Wyoming is designed to hold keys. But it's an important distinction because it's like valet parking. It's set up legally as a bailment. And that means when you park your car at the valet parking garage, you hand the keys over, pun intended, and the garage has the ability to park the car, and that's it. Right now, in securities custody, the custodians take your car out for a joyride, let Uber run around with it earning money, and then maybe they will give it back to you, maybe, but they have the ability to fail to deliver and all the games that we're familiar with, right? So in Wyoming, you actually have a choice. You can have that form of custody, or you can have the traditional form of custody. And I'm a former ERISA fiduciary, so I set it up to be ERISA quality. Now, we all know that's the highest level of standard, of fiduciary obligation. And there are a lot of things that I looked at in this industry and said, as an ERISA fiduciary, I could never sign up for that. For example, one of the biggest institutional players defines Bitcoin in its legal contract as, quote, a digital asset. Okay, if it forked into something, like let's take the Bcash example. They could just decide that all of a sudden Bitcoin is Bcash, keep the client's Bitcoin, and take the money, and if anybody actually sued, guess what? The judge is going to say, you signed a contract that didn't give you the right to actually have Bitcoin. So one of the things that the Wyoming custody law requires is that the customer contract defines the version of the source code in the contract for every single contract. And the fork policy that's coming out, every single digital asset custodian that I know of today has a fork policy that says we get to decide whether we're going to support a fork or not. And the Wyoming fork policy, again, higher standard. I hope that it sets an industry standard across the board, even outside of Wyoming. It requires, there are 3 different categories of forks, one of which requires affirmative customer consent. If you're not going to support the old asset, which is the Bitcoin example in the Bcash fork, and you're only going to support the new asset, you've actually broken the terms of your contract, and you need affirmative customer consent in order to do that.
There's definitely a chasm between the speed at which regulators in Wyoming are going and regulators elsewhere, that's for sure. There's also a chasm, right, Greg, between the speed at which, nimble young firms such as yourselves, they pulled you over from Goldman, right, and you guys are building out a solution a little bit faster than a big player like Fidelity, which is only servicing one cryptocurrency and is only dealing with a small handful of clients. What happens when they catch up, or any other big firm catches up? How do firms like yourselves prepare for that?
So I think we look forward to partnering with firms like that. We see a good marriage between smaller, nimbler firms and larger, more established, bigger brands. But we pride ourselves in being able to move fast and deliver solutions to customers. Ultimately, for us, it's providing a front-to-back workflow, client all the way from initial trading, provision of algorithms, smart routing, through to working with custodians and providing what we think is best of breed. Individual firms on the custody side, we found have their own unique power zones. Some are very good in Bitcoin. Some cover a lot of surface area in terms of different coins. Some have more insurance than others, et cetera. So it's really our goal to provide a best of breed approach and plug into as many places as we need to. Mm-hmm. But in terms of competition, I think it's really being about as fast and nimble and sort of working with clients and providing a front-to-back solution as we can.
Clearly, a lot of the tools that you are offering are ones that didn't really exist, even if we just think of something as basic as order types, right? Far more than the average cryptocurrency exchange. That's one aspect of it. But to what degree are you guys, and this could be a question for David as well, going out and reaching out to established hedge funds? We always hear about family offices. Yes, we get it. There are family offices that are your clients, or small crypto native shops. But what about the funds and the investors that actual people know about? What outside of multiple order types and a prime broker service, what are they missing? Or do they not see an investable opportunity?
I don't think they're missing anything. Genuinely, I don't think they're missing anything. They're just missing today their risk appetite. And the market's lacking the credit, and there's concerns all the way up to board level about the provenance of the coin. They have a lot of AML, KYC issues, but it's coming, believe it or not. You hear about Fidelity yesterday, tomorrow you're going to hear about the next big one. And when Bank One moves, why are they going to move? It's because their customers say, I want exposure to digital assets. Bank One moves, then Bank Two will move. So I don't think they're missing, and all those order types you talk about, they're happening today. I mean, the biggest participants on LMAX Digital today are the biggest players on the CME, right? They're the biggest players in the stock exchanges around the world. They're the biggest players on LMAX Exchange. They are highly sophisticated, and they are not going to OTC desks and saying, buy me $10 Bitcoin, right?
Why aren't they going to OTC anymore?
I'm not sure it ever existed, but certainly now there's smarter ways to do it. Greg's here, hopefully, showing everyone how to do some smart auto routing and use algorithms in a sensible way. But honestly, price discovery has now evolved, hopefully partly because of exchanges like LMAX Digital, so that you'd be crazy to phone up a broker and buy or sell any digital asset, right? You have to plug in to all the exchanges around the world, have efficient price discovery, and perhaps use a tool like Greg's to execute.
So I think coming from the traditional buy side, if you looked at what you needed to execute a large trade this time last year and now, last year you were missing a lot of things and you were doing a lot of self-help to do an OTC trade, repatriate your stuff back to your custody environment, et cetera. I think 12 months later it's quite a different story, and I think that's going to continue to evolve. I also think the evolution of exchanges and the advent of a different kind of market maker and liquidity provider and what that's done to spreads has really sort of changed the constitution of your ability to trade on exchange and self-direct and smart route, which is the same story that you would see across any form of security. If you looked at the history of trading NASDAQ stocks or the interdealer market in interest rate products or trading options, they all share a common arc, which is used to be a very manual process, became highly automated, made it more liquid, volumes grew, derivatives came, and there's a separation of things that are highly liquid, that trade on exchange, are centrally cleared, and then sort of a coexistence with those things that are less liquid, which are generally traded over the counter, which consume more balance sheet, which are the realm of sort of small cap stocks or off the run treasuries or those kinds of things. And I think you'll see the exact same arc happen in crypto, where the highly liquid things like Bitcoin, Ethereum trade on exchange. People can do self-help. The less liquid things are going to require somebody to make a bid and an offer and warehouse risk for a while, and that I think will ultimately be how over-the-counter and self-directed electronic trading converge just the way that they have in every other security.
What do you think about what's missing in terms of, if I'm a large investor and I see the Wall Street world and the crypto world, what do I need?
Well, it's a couple of things. The qualified custodian is a big one, which is why I was so driven to help solve that problem in Wyoming and to respect the way the technology works, instead of trying to force it into the status quo regime where you don't have direct ownership and we're all in a debtor-creditor relationship with our custodians. To your point about credit, I think this is an interesting one, because my guess is it will never see the kind of dealer credit applied in digital assets that we see in traditional assets, precisely because there is no fault tolerance in the settlement system of digital assets. In other words, if you fail to deliver a Bitcoin, it's a default. It's not something where your counterparty can just say, oh, it's okay, I'll record it as an asset on my books and have a receivable against you, right? That happens in securities all the time. There's, on average, 2 to 3% a day is failures to deliver, even higher in the treasury market, right? And there is no way to do that with true digital assets. When I say true digital assets, I'm not talking about the IOU versions, the trade-off chain. I'm talking about the on-chain settlement versions. There is no lender of last resort.
And the traders that I talk to, they really have, when they're engaging with each other, there are no standards. So there are no standards for settlement. The default is defined very differently across many of these brokers, especially when you're dealing with Asian and American firms. I mean, that's a huge issue.
See, I see that as a feature, not a bug.
Yeah.
And that's because, having come from both worlds, I don't think that, I think it would be a shame if the evolution of Bitcoin and other digital assets were to follow the evolution of previous markets, precisely because they have completely different settlement systems. I wrote a piece for Forbes talking about crossing the streams and how it's dangerous, because the settlement system for Bitcoin, this is one of the things I worry about with the ETFs. You've got the ability for market makers to operationally short, right? So they can issue more ETF units than they have collateral. That's in the standard ETF offering prospectuses. And for digital assets, that settles, Bitcoin settles every 10 minutes, whereas the ETFs settle T+2. So you're going to have mismatches there. You just are. These are very different animals.
Greg, how do you deal with that, where you can't necessarily plug and play the market structure that exists in equities into crypto?
So part of the service that we provide people is hiding all of the operational details of these exchanges settle this way, we settle these trades over the counter, everybody has different settlement times, we manage the credit risk, et cetera. I will say if there were a counterparty that allowed us to do atomic swaps between cash and crypto, we would love to be a client of that, right? So I don't think it should be regulatorily mandated quite in the same way that in NMS and other things, or in the securities world, things are regulatory mandated. But in a competitive environment, a solution like that would be immensely valuable to us as allowing us to manage our treasury function a lot more efficiently than we do today.
What do you think, David?
I think I'm going to differ here. I think, unfortunately, the existing world of credit will infiltrate into crypto assets. It's a bit like, I totally believe in on-chain transactions for a cup of coffee, even the price of a car. I think when you're talking about your pension fund, that's not going to be the case, and you're going to have disintermediation somewhere along the line. It happens today, right? So I have, okay, the trade formation actually today will be bank versus bank, but actually it's not. It's fund versus fund. Everyone there is assigning credit, be it in coin or in cash. I don't see that going anywhere. Sorry, Caitlin. I don't see any institutional block trading all happening on chain the way Caitlin sees that happening. Certainly not in Wyoming. I think, we operate in a global market. So I think an evolution to that is good. But in the meantime, to unlock this swathe of institutional money, remember, Fidelity managed $7 trillion, right? How big's the whole crypto market cap today?
10 billion.
There we go. So that's all I'm saying, right? To unlock that, you need credit. And so I believe it's coming, and I believe the solution will be there. I'm part of the solution, but ultimately I don't have the balance sheet that Fidelity want, right, to trade with.
We've got a few more minutes left. So wrapping up, thinking about the future. Everyone pull out their crystal ball. We're going to do some prognosticating. What's your big prediction for 2019?
Oh, you're going to see mainstream securities
The rest of
issuers.
2019. I guess we're halfway through.
It may be a little aggressive, but you're going to see a mainstream securities issuer issuing on a blockchain. Moody's, when SocGen issued its intra company covered bond, Moody's, they got it rated, and Moody's said it was credit positive that this was issued on a blockchain because it enables issuer and investor to communicate directly with each other. You actually, as an issuer, have the ability to know where those securities are. So if you're going to do a tender exchange offer for bonds or a share repurchase program for stocks, you can just communicate directly. Mm-hmm. You don't have to worry about the reality, which is that in most tender exchange offers, you're lucky if you can get out to 80, maybe 90% of your bondholders because you just don't know where they are. And the central intermediaries don't do a good job of allowing the issuers to find them. So that's just one of many advantages that this system has. And when Moody's came out and said that it was credit positive, I don't think it's very long before you see significant issuers issuing on a blockchain, and I think it'll happen this year.
Greg?
So I think two things. One, this sort of OTC landscape looks very different at the end of 2019 than it did at the beginning of 2019, and I think part of that is what's happened to spreads, the constitution of on-exchange liquidity providers, and the ability of those liquidity providers effectively to compete with exchanges puts pressure on spreads. It also puts pressure on exchange fees. So I think the complexion of what's high touch and what becomes electronic and smart routed and so forth looks very different at the end of this year. The last 3 years have really supposed to have been the year of the institution. I think 2019 will be the year of the institution. And so I think by the end of this year, you will see a few major players enter the space, potentially have an ETF, and start to see the foundation of, if you look in the securities world at the benchmark products, they have a derivative, they have options, they're highly liquid and traded on exchange. I think you're starting to see the basis of that, and I think by the end of this year you'll have the beginnings of that complex.
Simple. The first global bank will trade Bitcoin on LMAX Digital, and that will be the real start of the institutional wave.
You're going to give me that story, right, when that happens.
Special scoop, you just got it.
Exactly. Thanks. Thanks, everyone. Thank you. Appreciate it. Round of applause.